Hi, good evening, everyone. This is Chirag from Cipla Ltd. I thank the Cipla management team for giving us this opportunity today. From Cipla, we have with us today Mr. Umang Vohra, MD and Global CEO, Mr. Kedar Upadhyay, Global CFO, and Mr. Naveen Bansal from the Investor Relations team. Over to you, sir.
Thank you, Chirag. Good evening and a very warm welcome to Cipla's Q2 earnings call. I'm Naveen from the Investor Relations team at Cipla. Let me draw your attention to the fact that on this call, our discussion will include certain forward-looking statements, which are predictions, projections, or other estimates about future events. These estimates reflect management's current expectations of the future performance of the company. Please note that these estimates involve several risks and uncertainties, including the impact of COVID-19 that could cause our actual results to differ materially from what is expressed or implied. Cipla does not undertake any obligation to publicly update any forward-looking statement, whether as a result of new confirmation, future events, or otherwise. With that, I would like to request Kedar to take over, please.
Thank you, Naveen. Good evening to all of you. I hope that all of you and your families are safe and well. We appreciate you joining us today for our second quarter earnings call for FY21. I hope you have received the investor presentation that we have posted on our website. Resilient operations and focused execution of strategic priorities was the highlight for the quarter. We continue to applaud our employees' dedication and perseverance during these uncertain times. And we are privileged to have served the patients in India with our India and global markets with our in-license and organic product offerings in battling COVID-19. Dynamic capacity planning and coordination between procurement, manufacturing, and logistics teams have enabled us to continue uninterrupted supply of medicines to our global markets. We continue to support our business partners via various initiatives and further deepen our digital ecosystem across businesses. Coming to the quarter, we saw strong execution across the board, demonstrating good demand levers across geographies. As we had highlighted in the Q1 call, we have been also able to sustain a good share of cost optimization in Q2. We have also continued the focus on cash management, leading to healthy balances at the end of the quarter. Our business and cost reimagination initiatives and rigor on operational excellence continue to drive robust performance. We are pleased to report EBITDA margin of 23.4% for the quarter. While some proportion of costs linked to resuming on-ground activity has come back, we have been able to retain a good share on account of digital and efficiency initiatives. Our operating expenses continue to track a bit higher than the optimization potential of rupees 400 to 500 crores against our FY21 operating plans that we referred to in the last call. In the coming quarters, we will also be investing in growth-linked initiatives such as Berok Zindagi 3 campaign and other campaigns for consumer health products. Coming to growth for the quarter, the overall revenue grew by 15% on a year-on-year basis. Overall India business, which includes prescription, trade generics, and consumer business, grew 17% on a year-on-year basis. The India prescription business delivered 14% growth on a year-on-year, led by COVID portfolio, traction in chronic therapy, coupled with the recovering hospital business, partially offset by subdued seasonal triggers on the acute side. The trade generics business delivered healthy growth for the quarter, driven by strong demand and high order flow. Overall, our One India strategy continues to be on track. Our private branded market franchise in South Africa grew by 9% on a year-on-year basis in local currency and outperformed the market very significantly. The tender business there also delivered very healthy growth of 28% on a year-on-year basis. The US generics business delivered $141 million in the quarter, supported by continued momentum in the new launches, which include albuterol. We are pleased to report that the US business is trending very close to company-level profitability in the first half of FY21. Despite the contribution of Cinacalcet in Q2 of last year, we have seen very healthy and sustainable expansion of US EBITDA margin in this quarter. Coming to the financial performance, we would like to highlight certain specific items which are subsumed in our numbers. At a company level in the first half, the contribution from COVID portfolio was less than 5% of the revenues and EBITDA. As you are aware, there is a cap on the MEIS export incentives reimbursement scheme, and we have strong growth levers across businesses that will help offset this impact. For the quarter, overall income from operation is 5038 crores. Gross margin after material cost stood at 61.4% for the quarter on a reported basis. The decline on a year-on-year basis is attributable more to the contribution of high margin Cinacalcet last year. However, on a sequential basis, there was a 200 basis point decline, largely due to the change in product mix. Total expenses, which include employee costs and other expenses, stood at 1915 crores, increased by 12% on a sequential basis. Employee cost for the quarter stood at 821 crores, increased by 6%, driven by the increments that were announced with effect from July. The other expenses for this quarter, which include R&D, regulatory, quality, manufacturing expense, and sales promotion, stood at 1095 crores, increasing by 17% sequentially. This was driven by normalizing on-ground activity, which is sales-linked, offset by strong cost optimization and digital initiatives. Total R&D investment for the quarter stood at rupees 226 crores. While the percentage to sales appears a bit lower, part of that is on account of healthy revenue growth, accompanied by last year's adverse spends in the base. All priority projects are on track, and we expect R&D spends to increase as the respiratory assets progress in clinical trials. Reported EBITDA for the quarter is 1177 crores, which is 23.4% of sales. Tax charge is at an effective rate of 28.5%, and the annual ETR is expected to be in the same range. Profit after tax is 665 crore or 13.2% of sales. As of 30th September, our long-term debt stands at $275 million, which is largely towards our Invagen acquisition in the US, and South African rand 720 million for Miran business acquisition and other operational requirements at the South African subsidiary. Our working capital loans stood at rupees 300 crore in India, about $51 million in US, and South African rand 340 million, which act as natural hedges towards our receivables. Driven by very strong focus on cash generation, we will continue to be a net cash positive company as on September end. Outstanding derivatives as a hedge for receivables as on 30th September are $210 million and rand 660 million. We have also hedged a certain portion of our forecasted export revenues. Outstanding cash flow hedges as of 30th September are $179 million and rand 435 million. I would now like to request Umang to present the business and operational performance.
Thank you, Kedar. I hope everyone is well on the call. And before moving to the business and operational updates, I would like to thank our employees for their relentless commitment and perseverance during these uncertain times. I would like to start by sharing Cipla's continued response in battling the COVID-19 pandemic. We have continued to face the uncertainties of the pandemic with strength, determination, confidence, and strong patient focus to deliver what matters the most, which is our ethos of caring for life. We serve more than 1.5 lakh severe COVID-19 patients with our portfolio breadth of remdesivir, tocilizumab, and favipiravir. While our 24/7 toll-free helpline offered support for COVID-19 treatment products to more than 95,000 patients, we have also offered support for post-recovery of mild to moderate COVID-19 patients. Under the partnership with ICMR and NIV, we are also pleased to share that we have launched ELIFAST, which is a diagnostic kit for the detection of IgG antibodies against SARS-CoV-2, which is COVID-2 in the serum plasma of patients. We will be supplementing this with new launches in the diagnostic space for COVID as well. We have successfully implemented several business reimagination initiatives, such as enabling teleconsults, virtual conferences, remote detailing, and tools to improve diagnosis and treatment for physicians in a digital environment. Ensuring the safety of our employees and well-being continues to be the top priority for us as a company. With that, let me come to the strategic updates and the operational performance for the quarter. The strong performance for the current quarter is a culmination of relentless execution on several business and cost reimagination programs that we initiated at the onset of the pandemic. I'm pleased to see the continued effort in cost management, resulting in a significant optimization during the quarter and helping us drive the strong EBITDA margin that we have reported. In India, despite the COVID-related challenges, our One India strategy continues to see seamless execution. Coming to our business performance in India, we continue a strong momentum and have reported market-beating growth now for the fifth consecutive quarter. India prescription business grew 14% on a year-on-year basis, supported by continued traction in the COVID portfolio of remdesivir, tocilizumab, and favipiravir, along with our regular core growth in the rest of the portfolio. The quarter also saw traction in chronic therapies and modest recovery in the hospital portfolio, which offset the subdued demand in our acute business. As per IQVIA July to September 20th, we continued to deliver market-beating growth in respiratory, where we were 29% versus the -3%. In the inhalation segment, we were 10% versus a market of 7%. And in urology, where we were 6% versus 3%, as the lockdown restrictions continued to ease during the quarter. Cipla ranked number 2 with a market share of 7.6% in chronic therapies and grew by 9%. We are confident that the momentum will continue in the quarters as we have outperformed the market across several therapies on a sequential basis. We are also excited to launch Berok Zindagi 3, Cipla's flagship patient-focused respiratory initiative on a digital platform. The trade generics business continued its healthy growth. The quality and health of the business has significantly improved, led by strengthened hygiene, strong governance and review mechanisms, leading to healthy tractions and margins. In our consumer healthcare business, we are happy to see the scale of roughly around 180 crores in H1 of FY21. While this includes the sanitizer sales, which may not continue at the same level, we see strong traction with our consumer brands post-transfer from the trade generics business. We will continue to watch the evolving volume growth patterns in our core therapies as demand levers stabilize in the coming quarter. Coming to a US generics and lung leadership update. The US generics business delivered 141 million in the quarter, supported by continued traction in new launches of albuterol, the esomeprazole oral suspension, the DHE nasal spray, and these are supporting the base business growth. In line with our commentary on limited competition launches, we launched dimethyl fumarate in Q2. We expect these momentum on new launches to continue. We have maintained robust supply of albuterol HFA in the US and pleased to inform that we have the prescription share of 84% of the Proventil market now, as per IQVI ending 2nd October. Across the 3 albuterol products of Proventil, Provera and Ventolin, we have over 8% of weekly TRX market share in the total market and over 10%, over 11% of the generic market. We continue to monitor our market share given the evolving competitive landscape in the larger albuterol market. Our respiratory pipeline, which includes generic Advair and other complex inhalation assets, is progressing well. On a half-one basis, the US business is now trending close to company-level profitability. The business has seen healthy and sustainable margin expansion over last year, despite the contribution of Cinacalcet in the base numbers of the last year. Coming to our SAGA, which is a South Africa and Global Access business and the emerging markets. The South Africa private business delivered strong growth of 9% in local currency over Q2 last year, while the tender business grew by 28% in local currency terms. We are pleased to report that Cipla was the fastest growing corporation in the South Africa private market, with new product launches forming a significant growth driver. We maintain a market share of 7% as per IQVIA in March September 20. In the OTC space, we grew by 8.2% and maintained a strong market share of 7.2%. We also entered into an exclusive partnership with Alvotech for the commercialization of 5 biosimilar candidates in immunology and oncology. The emerging markets business has performed as per expectations and maintained scale on a year-on-year basis in US dollar terms, driven by demand across all regions. The European operations grew 24% year-on-year. The growth was driven by strong in-market performance and market share gains in key direct-to-market businesses. We are happy to report that remdesivir supplies have commenced for multiple emerging markets. On the specialty front, through our associate Avenue Therapeutics, we will continue to engage with the US FDA to understand the observations on the CRL for IV tramadol. We will continue to evaluate multiple options to structure our specialty investments and also further the progress of this asset with the FDA. We have submitted our last response to the US FDA regarding our Goa site and will continue to engage with the agency to comprehensively address the observations. Turning now to our outlook, we continue to monitor the evolving demand patterns across our business. We believe the underlying fundamentals of our business remain strong, which along with the operational agility has helped the company deliver a resilient performance in H1. We will continue to transform healthcare delivery for physicians and patients on digital platforms and we are tracking our productivity metrics and the progress of our product pipeline. Our priorities for the second half of the year include strong governance around the safety, supply security, cost control, and working capital management. Scaling up our business across branded and generic markets of India, South Africa, US, and emerging markets. Prioritizing key launches with focused execution and collaboration with regulatory authorities. Continuing to operate our facilities globally with the highest levels of compliance and control. Constantly building capabilities and talent for transformational business outcomes. And turning adversity into an opportunity by continued focus on digital adoption and cost reimagination across our businesses. With this, I would like to thank you for your attention. I wish you and your families well, and will request the moderator to open the session for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask questions may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask questions, please press star and 1. The first question is from the line of Prakash Agarwal from Axis Capital. Please go ahead.
Yeah, thanks for the opportunity. Good evening and congrats on good numbers. So first question on India business. So you mentioned RX business growing mid-teens. If you could help us understand what would have been the growth, just the RX ex-COVID, that would be useful.
I'm not sure we're giving that guidance, but I can just say that RX ex-COVID is at market for most of the therapies that we have spoken about.
You mean market IPM growth of mid-single digit?
Each therapy is a different growth. So what I meant was that if you take out the COVID products, which we're not guiding to right now, I think Kedar has mentioned that overall COVID is roughly about 5% of the company numbers. Right? Is that right, Kedar?
Yeah, for the first half.
Yeah. So he's mentioned that in his commentary. So I think if you exclude more or less that, I think the rest of our by therapy, we have performed mostly at market.
Perfect, great. That helps. And secondly, on gross margin, we have seen some decline both quarter on quarter, YOY. What would be the main reasons? I understand the share mix has changed. Would it be also these COVID-related products? Global access, tender business, anything I'm missing here, and what should we build in going forward as well, as COVID, I think, is here to stay for another 6 months?
Yeah, Prakash, largely it's a mix of COVID portfolio. But as you know, while gross margin level COVID portfolio appears little lower than the company level, the EBITDA is in fact quite in fact higher than the company level. So yes, gross margin is largely a mixed issue at a company level.
And how do we see that, sir?
No, see, it will depend. There are multiple variables, including mix and other things, but there is nothing adverse, I would say, individually in the lines of businesses that we have.
Okay, thanks. I'll join them.
Thank you. Thank you.
Thank you. The next question is from the line of Nithya Balasubramaniam from the Bernstein Research. Please go ahead.
Congratulations, Umang and Kedar, on a fantastic set of results. I had a couple of questions initially on the US business. So on Preventil, you mentioned that you're hitting 84% TRX share of generic Preventil, which means that you're maxing out the potential there. So from here on, you really need to capture share of the quote-unquote prescriptions that are written as albuterol. I'm seeing a little bit of softening in terms of your market share ramp up in the weekly TRX data. Are you finding it a little challenging from here on, grabbing shares from albuterol prescriptions?
So, Nithya, I think the latest data of October 23rd actually shows us even higher in terms of prescription capture. And if you actually go back approximately a year back, the Proventil category was somewhere around 6 or 7% of total albuterol category. And Proventil as a category was roughly around 6 to 7%. And I think we're seeing that we're now definitely higher than 10. So I think we're trying to do both. Of course, it will depend on how we expand albuterol further. And, from 6 to get to 9 is easier, from 9 to get to 11 is tougher. So I think yes, but we are continuing to see the ability to supply and market more volumes here.
So look, just to help us understand, what would it take, right, for the prescriptions that are written purely as albuterol? There is a Cipla, Lupin, maybe Perrigo at some point of time. There are all your AGs as well competing for that market which is written as a generic albuterol. So what are some of the reasons why pharmacist is likely to substitute it with a Cipla product rather than somebody else's?
I think, Nitya, I think the mechanics of the market are not very different. There are 5 consolidated or 6 consolidated buyers here. And I think, if you were to broadly look at it, we believe from the data, and of course now quite public and evident, we believe from the data that there is a large number of prescriptions are written as albuterol, right? And therefore there is a switching hypothesis here. And I think it's not something that we control. It's clearly something that is a mechanic of the market. So as long as it's a function of how each one of the market participants are going to shape this market. So I think it's working on that principle, Nitya. So it's consolidated.
Sorry, what I was trying to get at was, does this mean that from here on to grab share of that market, the pricing might actually come down because you might have to offer something?
No, I don't believe the price. I don't think the pricing is something that we are concerned about, Nitya, because there have been people who've exited the market as well in recent times. And I don't think this is a pricing category, and also the sheer volume of this market is very high, 65 million units. This is a very high volume market, and for anyone to sustainably continue to manufacture at this level of high volumes is a little bit of a worry. So I think the market, I don't think pricing is a concern for us.
Got it. A quick one on Tramadol. Umang, do you now have visibility on whether you're getting a Type A meeting, and do you know when that Type A meeting is happening?
Yeah, I think we can't disclose the next steps with the FDA in particular detail, but, I think the avenue is in the process of obviously scheduling an interaction with the FDA, and, which is typical of any company, which will get a CRL in the specialty space. So I think Avenue is taking this discussion forward. We are conscious that they are a public company as well, and therefore would not want to comment. But yes, there is an interaction that Avenue would seek, if not it has already, from the FDA on next steps regarding IV Tramadol.
Okay, I'm going to squeeze one more in. Kedar, did you mention that the 400 to 500 crore savings that you had anticipated this year, we are tracking lower than that? It's a little less than anticipated?
No, I said in fact more. So we're pleasantly surprised with the power of digital engine, which has started working for us in all areas of the operations.
Any guidance on how much of this is likely to sustain going forward?
Yeah, we would like to have a large part of this sustain in the coming quarters and become part of the business model actually. So I think the reimagination initiative that we have launched in each of the market and each of the functions will allow us to sustain a large part of this efficiency going forward. And let's see, a couple of more quarters, we'll be able to give you some precise estimate of how much has that sinked in our base number. But suffice to say that the potential to save is much higher than what we spoke earlier.
Thank you so much and all the best.
Thank you.
Thank you. The next question is from the line of Anubhav Agarwal from Credit Suisse. Please go ahead.
Yes, good evening. One question on albuterol. Just wanted to understand, Umang, why is this product still in shortage? When I look at IQVIA data, it shows me that the total units now are not higher than what before the generics came in? They're largely same number of units being consumed by the market right now, whereas Cipla and Lupin have added capacity only. Even if Perigo has gone out, the capacity is still being added to the market than what it was before generics came in. So why is this product still in shortage?
Why is it in shortage
actually?
Yeah, so I don't know whether I personally am not. I personally don't believe that this product is in shortage. I certainly don't think that that's the signal we're getting from the market. I think what may have happened is because of the fact that we had a significant competitor exiting the market recently, that there might have been a little bit of a, I would say, a discontinuity in the market. And maybe that's the reason it went onto that list. But I believe that, I think the market is likely to be well supplied. And what we are seeing is possibly a substitution of some of the branded players, including the authorized generics, to some recent people who have come into the market, including us.
And like the question Nitya was asking, actually that's the doubt I also have, that you've been in the market now for almost 7+ months. So is there capacity constraint at Cipla for that you could not get enough market share when Perigo exited? I know last 2 weeks, in fact today's data also shows some market share increase for you. You are now turning 10% market share, but we would have expected you to take a higher percentage market share than some of the new guys who have taken. So are you capacity constrained and you are in the process of adding capacity, that's why you could not take it? Or
no.
Other dynamics that you are or substitutable version for Proventil, not for ProAir, did that impact you taking market share?
I think it could be a mix of all of them, because when we were approved, we didn't have any capacity. We didn't have any product which was available to be selling in the market, right? We were approved in March when we thought we would be approved 6 months later. So for us, it was not as if we were ready for a launch or had gone through a set of CRLs that we knew there was a particular goal date that we were targeting. So we had limited stock, and based on that, we ramped up with it, right? So realistically, the 6 or 7 months that we are talking about is possibly only equates to 3 to 4 months. But, one thing that I would like to say, and I mentioned this to Nitya as well earlier, Proventil as a total share of the albuterol market was about 6 to 7% earlier, and we believe in terms of weekly prescriptions, this is now over 10%. So the market is showing the hypothesis where Proventil as a category itself can be driven up, and I think that's something that we are trying to shape in the category. Just from my perspective, I don't think anyone's objective in a market like this would be to hog market share, because these are difficult products to make and very complicated supply chain. So the day you try to hog market share on a large volume product like this, which is at 65 million, I think, that it's not so much pricing, but it's more your own supply chain that you have to be concerned about. And the product is attractive enough even at this level of volume.
Okay. So just one clarity on the response that you said. So should we assume even now, going forward, your market share gains will be gradual, or let's say there will be a time, let's say a quarter down the line or something like that, where your capacity comes in and we could see a step jump up in your market share?
We have adequate capacity. I don't think the issues are capacity. I think the issue is how sustainable we want to see this capacity. We want to see our production going forward. So we can produce at a much higher place, but I would always like to keep a relatively high share of inventory in a category of a market like this. So I think that is one answer. So specific to your question, I think whether the market share gains would be gradual. Yeah, they could be gradual. I think if you look at our overall positioning, we moved from, even in the last 4 months, we moved from almost 7% or 8% to I'd like to believe over 10 or 11%. And I think this type of a movement could keep happening over a period of time.
Okay. Thank you very much.
Thank you. The next question is from the line of Krishnendu Saha from Quantum Asset Management. Please go ahead.
Yes, okay. Yeah, thank you for the question. Just on albuterol again, if there's less price erosion, the market is stable, Why we do want to hold inventory? Isn't it natural for us to gain a higher market share? Question one. Question two, on the South African front, we've been doing well on a quarter-on-quarter basis we don't track quarter-on-quarter, but just 65% on a QMC basis and 83% on whatever the number is on a YOY basis. So how much of that is sustainable? Some light on these two, please. Thank you.
So the second question I couldn't hear really well. Could you just provide some?
Yeah, just the South African market. Yeah. We've been doing well. How much of that is sustainable and what has actually happened out there? So it's around 15 to 20% of our revenue. So how much of it is sustainable?
Yeah, certainly. So I think the South African market, from the way we look at it, I think it is quite sustainable. And this ability to, we've shown the ability to continuously beat market growth now. I think we've done that, in my opinion, at least for almost 8-9 quarters that we've been looking at it, so, or even more than that. So I think it is sustainable. I think it's a relatively strong business in South Africa. So I don't think it's not a flash in the pan. It's a sustainable trajectory.
Right.
And the first question was on inventory. Why do we want to keep inventory?
Yeah, because you spoke about the fact that the pricing is stable. We have capacity to produce inventory. You want to hold inventory. So just really understand what is the logic, what we see out there.
Yeah, because I think this is a category of products where if you even have a blip of a missed week or 2 weeks of production, it's not easy to recover it. I mean, the same linearity doesn't happen because these are devices and everything else. So I think the biggest problems happen when you produce too fast, right? And at the same time don't have adequate inventory of materials with you. So I think we've, now out of our experience of doing albuterol and several respiratory devices elsewhere in the world, I think we are quite clear on how we would like to manage the supply here, which is to be cautious with both our inventory as well as the flexibility in our production system to take on higher production.
Okay, it is not a bottleneck at the material level or at the device level. It's a purposeful.
There is no bottleneck.
Going. Okay.
There is no bottleneck, absolutely.
And a couple of small questions. India, how much do you think is the current this number of 210 crores is sustainable for going ahead for the quarter? And Kedar, if you could just throw some light on the margins going ahead for H2, please. Thank you. That's from my side.
Yeah. So Krishnendu, I think we have seen some of the orders in the trade generics business which have got bunched up a bit in quarter 2. So to some extent, I think there could be marginal moderation in quarter 3. But demand environment continues pretty strong.
Right.
So that's the thing. And the supply for COVID medicines is here to stay. And we have, like what Umang alluded, in addition to one site which is captive, now we have 2 outsourced sites. And we continue to scale up manufacturing and supply for remdesivir. And that's here to stay. In terms of margins, actually the margins of prescription business and generic business have gone up. YOY. So our gross margins for most of the businesses on a year-on-year basis have gone up, which is quite healthy. So I think mix is the only thing that we have to watch for. Otherwise, there is nothing adverse. The pricing continues strong. The work on cost reduction continues strong. And except COVID, I think the mix is good as well.
How much of it is the cost cutting is still to be added for H2? Or say, let's put it 1 year. How much of it is still to be added? Sorry,
like what we alluded, I think we are quite energized by the promise of digital initiatives in each part of the company's operations. And that has allowed us to reimagine our ways of operating. And our investments are going on in that direction. And we would like to believe that we do retain a larger part of the cost control that we have seen as an inherent part of the business model itself. So let's see a couple of more quarters, then we'll be able to come back to you with precise estimate as to how much of that has gone into base. But as I said, I think we would be able to save a bit more than what we thought we'll be able to save for the year. Thank you.
Thank you. Thank you.
Thank you.
Thank you. The next question is from the line of Sameer Baisiwala from Morgan Stanley. Please go ahead.
Thank you so much, and good evening, everyone. Just a couple of questions. So, one is for the US, the Tech Fidera launch. Umang, is this a meaningful launch, or given the competitive intensity, the prices have gone down to nothing?
I think it is a competitive launch. It is a fairly competitive launch. So I don't think it will be meaningful enough the way we had perhaps envisaged it.
Okay, great. And second question on the India business. So if I'm not wrong, the COVID-19 drugs contributed up to 250 crores to sales in the quarter. How much of this is sustainable and how much of this you think is one-off? And if that's the right way to think about it.
No, I think it's the right way, Samir. I think part of it, clearly, I don't think all 250 will be sustainable, but the more we are understanding of this, of COVID now, it is going to be endemic and will continue. May not be at the same level as right now, but I think it's going to be endemic and will continue. So I would like to believe that in its worst form, I think about 30%, 35% of this should perhaps always be sustainable. That's my sense. I think the other thing that I would probably also say is that it also depends on cases. So if cases are relatively, if there are no cases, then obviously there's no demand. But we've seen this pattern of cases go up and down, right? And the rest of the world is now going through a huge outbreak again. So I think it will be responsive to those two, but I clearly see at least from the current levels, at least 25 to 30% staying in the mix, at least, due to the endemic nature of this pandemic.
Okay, great. And just on the doctor connectivity, and I thought it's very impressive that I could see on your slide 2.5 lakh doctors that you could have, or maybe unique doctors that you could connect through virtual conference for CME. Looks like about 20% of India's total doctor population. So if you can talk a bit more about it. I mean, is the entire doctor fraternity now digitally connected with the manufacturers? So any thoughts on this?
Well, we're seeing. I think it's obviously by therapy and by indication, but we've certainly tried to engage with doctors especially around the time when there was no COVID, when there was limited activity due to COVID. And I think some of that is sticking, some of that is going back to how it was earlier, but we've seen a propensity in doctors to engage more virtually. I think it matters, it helps their time, for one. It brings them and their patients more safety. If there are not more than 10 or 15, usually in a doctor's chamber, there could be 10 or 12 reps waiting to meet the doctor.
Yes,
we're seeing with the virtual assist program that, the doctor has more time on their hands. They can meet the reps when they want to, even on a way to the office. If they are being driven in their car, they can, have a virtual consult with a rep. So it allows them to manage their time a lot better. And at the same time avoids crowding in a doctor's clinic. So a lot of the doctors are responsive to these changes. And I hope and I pray that this trend continues because it allows doctors to use their time better and people in their clinics to be less susceptible to infections.
Okay, great. And just with your permission, final one on albuterol. I cannot not ask a question on this. So, a couple of things. If there was a demand, do you have capacity to take, say, double your current sales and say maybe move up to 20% market share? Second is, how's been the behavior of 3 authorized generics in the market? Do you think they will get more competitive, or do you think at some point in time they may want to exit? And third is your take on the margins, where you mentioned the US business is now trending close to the company average in the presentation. I would have thought it would have gone much higher given the albuterol contribution.
Yeah, and I think our U.S., just on the last point, I think the U.S. margins that we spoke about our net of R&D, it's the fully loaded margin. There's nothing, there's no central cost that has not been taken. So it's a fully loaded margin. It's that company. And I think that's good because just a year back, Sameer, we were just about break even. So I think there's been a big uptick on account of albuterol. But just specific on this, there are, in as much as we think that there are only 2 generic players, there are 7 competitors in the albuterol market. There are 3 AGs, there are 2 brands, and then there are 2 generics now. One is this, and 1 generic is just exited, right? So if you look at it, there are 7 players in this market. And I think one has to also understand that market in that perspective. Having said that, it's a 65 million unit market, which is a very, very big market. So I'd just like to say that if you were to look at the overall capacity, yes, we have capacity to go up to 20 to 25%. Would we want to go there? Is a question at some point in time that we will obviously answer over a period. Now, of course, there's enough flex to be able to reach a certain level of targeted share that we want to get to. But it's not something where we want to build it overnight. I think that we're pretty clear about, because what we're also very clear out of our experience of running respiratory products in the rest of the world is that I think the sustainability of your supply and your product is more important than just how quickly you reach a targeted share. And frankly, there's enough value in this market to do it over a quarter or 2 quarters. So I don't know if I answered your question, but that's how I look at it.
No, you definitely did, Umang, and thanks for this. But just your thoughts on the 3 AGs which are there in the market?
I think they are competitive. They're competitive, and I think they're pretty much functioning like proper generic competitors. So we believe that actually the way we look at it, that there are 5 generic players in the market already because it's the 3 AG. Plus it's the 2 generic players now. And when the third one who's exited comes back, then there would be almost 7 players who are non-brand in this market already.
Okay, great. Thank you so much. Very helpful.
Thank you. Before we take the next question, we'd like to inform participants that in order that the management is able to address questions from all participants in the conference, please limit your questions to 2 per participant. Should you have a follow-up question, we request you to rejoin the queue. The next question is from the line of Nitin Agarwal from IDFC Securities.
Thanks for taking my question. Umang, we've had a very dramatic improvement in our cash position over the last few quarters. In the past, you indicated that you've changed a little bit of track on the specialty side. So what are the thoughts about capital deployment when you go forward from here on? Given the balance sheet, I guess, given the run rate, it would keep getting strengthened from here on.
Maybe Kedar should take this. Kedar, do you want to comment?
Yeah. No, I think, Nitin, this efforts on generating and preserving cash would continue. I mean, that's a key part of our internal KPI metrics now. And across businesses, we are doing good work, and that will continue. And as you would see, we still have certain debt servicing obligations on the balance sheet. There are aspects of investing in capital expenditure for development and capacity for respiratory. So I think there are multiple users, Nitin, and all that will continue.
But on a more strategic level, any specific M&A spaces you're looking at from a 2 to 3 year perspective?
See, M&A, our ability to fund a large M&A continues to be there. It was always there, and either by virtue of cash on the balance sheet or by virtue of being able to raise cash at a competitive interest rate. I think ability to fund a large M&A is always there. It was always there, and it will always be there. And subject to a strategic target being in front of us, I think that would probably be a determinant rather than saying that we have cash balance and hence let's do. So I think we would continue the governance on cash. That will be important for us.
in the field, one expert on Truvada. Has the supplies for the product started or not? Or is it going to be a relevant product, supply product for us, or as an opportunity?
You mean product supplies for us launching as a finished player? Finished product player, or is...
I thought we had a partnership with the first to file on this, or that was the case on Truvada.
Yes. So I think we have been told the first to filer has launched their product in the market.
Oh, thanks.
Thank you. The next question is from the line of Vishal Manchandra from Nirmal Bang. Please go ahead.
Yeah, hi. Thanks for the opportunity. In the last call, you have indicated about a respiratory asset which is partnered. So could you update? There was a complete response letter. So has it been addressed?
Sorry, I could not hear properly. Maybe it is my connection. Can you just repeat your question, please?
So in the last call, you had indicated there is a partnered respiratory asset where you have received a CRL. So just wanted to understand if that CRL has been addressed and responded to.
Well, it's linked to the closure of some studies that were done by the partner. So I think the moment the studies are done, the partner will revert. So around any time now or in this quarter, we are hoping that the partner will revert back.
So could you give some color on whether it's a nasal spray or it's an inhaled? It's an MDI inhaler, and all in terms of size, whether it's less than $500 million or greater than $500 million.
So we don't provide that level of transparency on the portfolio, but I think what I could say is in the inhalation, it's an inhaler product.
Okay. And would this be over and above the one? So you guide for one respiratory launch per year. So will this respiratory partnered asset would be over and above the guidance that you have?
It could depend on the timing. Could definitely depend on the timing of the launch.
Okay. Yeah, that's all from my side. Thank you.
Thank you. The next question is from Shyam Srinivasan from Goldman Sachs. Please go ahead.
Hi. Thank you for taking my question. Just this one to Kedar. You talked about gross margins being lower, but for COVID portfolio and for the overall portfolio, margins being similar. So how should we look at for the second half? Because do you foresee that the gross margins will be whatever the 61-62%, but margins on the EBITDA line could not be very different? Is that how we should think about the second half?
Yeah, so actually, as you can imagine, gross margins are subject to multiple variables. Primarily, mix is playing a large role for us. And as I said, COVID portfolio gross margin is lower than the company, but EBITDA level, they're higher than the company. And that will continue in the balance of the year as well. So I don't want to hazard a guess on how much mix will be there for COVID and non-COVID. But as I said, excluding COVID, most of the businesses, if not all, have seen a significant gross margin improvement on a YOY basis. And that's based on the mix in those part of the businesses, as well as pricing levers, as well as cost containment levers. So I think all these levers have played out. And I think those will continue in the balance of the year in the second half as well. And as the proportion of some of the niche opportunities in the US business, some of the chronic therapies in India business, I think if all of that improves, I think we do have strong tailwinds.
Got it. Thanks, Kedar. The second one is on R&D expenses. You said that optically it's looking lower on a percentage basis. Are there any projects that are coming up for this to go back to 5 or 6% of sales, or this is a level that you think we can slowly, it will be like a slow creep rather than like a step jump in terms of R&D?
Yeah, I would think so. I mean, probably one should model up to 7%. I don't think it can dramatically go from now to 7 immediately, but it could be rather slower creep, and it would depend upon, I think, a bigger determinant is a high-value clinical trial, which we saw last year in terms of Advair. So I think a similar spend in terms of the ongoing respiratory project, the quarter in which that gets triggered, I think you could see some increase. But as we said, most of the key projects are on track. And on an annual basis, I think quarterly, some of these things are not fully predictable. But you should expect us to continue to invest between 6 to 7% of revenue.
Got it. The last question again, I am just going line that end, but DNA, we saw 5% this time. Is there something structurally changed? Because this number seems to be trending down. Is there something we keep in mind?
No, I think the biggest charge there is on account of the US acquisition, and as we have completed 4 years to the acquisition, some of the assets are sort of getting retired from the gross block, and that might be the reason why amortization charge is low, but depreciation could continue at this rate, and depreciation could marginally go up. But amortization would come down.
Thank you. Before we take the next question, we request participants to please limit your questions to 2 per participant. The next question is from the line of Nimish Mehta from Research Delta Advisors. Please go ahead.
Yeah, thanks for the opportunity. I actually missed your comment on the opportunity in Truvada. I understand we are a API supplier or supplier to Teva, who is 180-day exclusivity. So is this opportunity captured now, and how big do you think is the opportunity?
I think this, for any of these, look, I think that when you say opportunity captured, there is only one first to filer in the market right now. So like any other generic product, for us also this will be an opportunity when it becomes a generic. I think if your question is whether the first filer launched with our API, yes, that is correct, and we were public about it earlier.
So, did we not have any profit sharing agreement with them so as to kind of, make it a very valuable product, even if it is API? And my question is not just limited to Truvada, it's also, I think, a Cipla, which probably is where you might be a supplier. So if you can, let me know about both the opportunities and, opportunities in the sense, whether they are high value opportunities or not. How should we look at it?
Well, they're reasonably sized opportunities. I don't think this is here the full product is not ours. The competitor, the first filer, got this product pretty much. So the rest of the chain is with them. So it's like any other regular API product. I don't think that this is. It's a reasonable opportunity, but I can't say that this is not an esomeprazole like we had earlier.
Okay. So if I understand you well, what I understand is that Teva themselves also might be manufacturing their own API, plus they might be sourcing from Cipla. Is that how we should look at it? Because, if Cipla is the only supplier, then it's a significantly great opportunity, enough to show up on the numbers. So that's what I'm trying to understand.
Yeah, I don't think Teva is manufacturing API for this, but the rest of the chain is with them. In the case of esomeprazole with Teva, pretty much the whole product was manufactured with Cipla. So I think that is the difference I was mentioning to you.
And
therefore, let me just, if I can just complete for a minute, please.
Yeah, sorry.
Therefore, the economics of this are not the same economics as or the profit sharing, etc. is not the same economics like we had for esomeprazole. That's what I'm trying to say. So it's like a reasonable product for somebody who has a first to file, where you are a supplier to a first to filer. It's something reasonable like that. It's not a huge curve bender for the company.
Thank you. The next question is from Kunal Dhamesha from Emkay Global. Please go ahead.
Thanks for taking my question. So, I think last quarter you provided some detail in terms of the size of the consumer healthcare business and growth in the trade generic business, adjusted for the consumer health business. So, can you provide the details for the quarter?
Kunal, roughly, Kunal, roughly the magnitude of percentage growth remains in that same range. So the percentage growth, in fact, for trade generics business this quarter, as I mentioned, there is some bunching up of the orders, is fairly high, and this the consumer healthcare business also continues at that run rate. So both these businesses are on that trajectory. We want to avoid too many growth numbers being spoken about, because the more granular we go, I think there'll be a expectation and responsibility on us to keep talking every quarter, and we want to avoid too many growth numbers. But suffice to say that these two are growing very strong, and the process of consumerization is very healthy, and it's getting good traction. The early metrics of consumerization that we track for the brands which have got transition look very healthy. We are quite happy with that.
Okay. And just if you can provide the qualitative color on, if the CHL's gross margins are significantly better than trade generic business? Would it be fair to assume that?
Yeah. I mean, I won't compare head to head or like to like, because the portfolio is different, and the trade generics, as you know, is more a channel business, and that is more the consumer health is more a consumer business. So I think head to head comparison is not appropriate, but going forward, we do expect each of the transition brands to have much higher gross margin pricing, and demand stickiness. So all these intended objectives are being seen in practice as we transition each brand, Kunal.
Okay. Thank you for that. And the other question is on the other expense savings, as you have alluded that you are looking at the reimagination of each business vertical. So if you can just throw light on which all the line items which could be impacted by your this process transformation, maybe in the other expenses or in the cost of goods sold item, if you can just throw some light in terms of what kind of processes are being reimagined. Whether it's a selling process or...
So actually each function and each market is seeing this reimagination. A large part of that is in the markets where we interact with customers. So the processes where we engage with channel partners and we engage with healthcare practitioners and patients. All of those have been reimagined to a great extent for the virtual reality of the business model. And the P&L lines where you're seeing this impact from a 4-5 line P&L that we disclose in other expense and people to a great extent. And within other expense, I think there are multiple line items which is getting impacted. And as we said, we are pretty energized with the efficiency and the speed, the simplification and the agility that this thing brings in. And we will continue on this journey.
Thank you. We'll be able to take one last question. We take the last question from the line of Surya Patra from Phillip Capital. Please go ahead.
Yeah, thanks for taking my question. So in fact, see about the COVID portfolio, the contribution what you have mentioned, is it possible to split between what is that for India and outside India? Or if you can give some sense that the export business is whether it is or what times of India COVID opportunity or anything on that side, that would be really helpful. And simultaneously, is it possible to have a sense about the kind of the volume in the remdesivir side? Because we have multiple facilities that we have arranged for this opportunity.
Yeah. So Surya, I think we are conscious of the feedback that we are getting from some of you that we probably are being over transparent in terms of granularity.
Yeah.
While we are keen to engage with the street on a basis which is quite candid and transparent, I think we are also conscious that multiple granular numbers do not help beyond a point. So I think suffice to say that COVID is an important part of the portfolio, but it's not that the whole growth and the whole profitability improvement has come from that portfolio. And it's split. Currently, the COVID portfolio is split into India and emerging markets, the international business.
Yeah.
And the promise to grow exists in both these territories. And going forward, some of the other therapies which had an impact, such as acute, I think they will shape up as well. So I think the way our revenue trajectory and profitability trajectory would shape up in the coming period will depend upon how we are able to influence the growth of other therapies which have seen little bit of a pressure now, We are confident because a lot of customer actions and a lot of field action is going on there as well. So that would shape up positively, and this, in our view also, there is lots to play here on the COVID side.
Okay, my point of the point that for which that I was asking this question is that since there is an alliance for the alliance for remdesivir, let's say, that is for larger so many countries, and obviously at this current juncture, this product is also kind of a shortage-based product. So opportunity-wise, going ahead in the subsequent quarter, possibly this portfolio can be even stronger, more and more.
That's true, Surya. That's true. And I think not only remdesivir, by the way, I think we have favipiravir, we have few other opportunities. We have recently launched under our diagnostics initiative, ELIFAST test. You must have seen that.
Yes.
So I think COVID will remain. We are conscious of our responsibility to service the needs of patients during pandemic. So it will remain we'll be occupied in servicing the COVID needs of our global patients.
Okay. My second question is just on the One India strategy. See, obviously we have got or we have seen some benefit flowing from the COVID portfolio, but otherwise, excluding that, whether the One India strategy has really contributed the way that we have anticipated, or what incremental benefit that we should really be trying to achieve through these for in terms of growth or in terms of profitability for Indian operations.
Yeah. So Surya, the synergies of One India business between prescription, trade generics and consumer healthcare exists in portfolio, exists in go-to-market approaches, it exists in commercial excellence, it exists in distribution, logistics and digital. So there are multiple avenues in which we could synergize these three businesses together, and all of them are playing out as we are speaking. And we will continue. And as we said, at a specific time when we are able to communicate in much precise terms, we will do that. But one example I just mentioned about the consumer business, I think it's playing out well.
Okay. So a portion of the profit margin expansion is purely from that. Can we say so? Despite the business impact because of the COVID, excluding the.
One is margin expansion. Secondly, stickiness of the demand.
Okay.
And thirdly, some of the price improvements, which always is not possible in the channel business. I think all these objectives are being serviced to.
Thank you very much. We'll take that as the last question. I would now like to hand the conference back to the management team for closing comments.
Thank you. Thank you everyone for being on the call. In case you have any follow-on questions, please feel free to reach out to myself or to our investor relations ID at investor.relations@cipla.com. Thank you so much. Have a very good evening ahead.
Thank you very much.